On February 12, 2026, while the American public was distracted by the algorithmic noise of the Super Bowl and the latest cycle of manufactured political outrage, a quiet notification was dispatched from the Office of the State Comptroller in 3 major U.S. jurisdictions. It was not a press release. It was a 42-page technical memorandum classified under Internal Revenue Code Section 103, sent directly to the primary clearinghouses in New York and London. The document confirmed what the mathematical models had predicted since the liquidity tightening of 2023. The interest coverage ratio for Tier 1 municipal bonds in Chicago, San Francisco, and Philadelphia had finally inverted. For the first time in 84 years, the cost of servicing existing civic debt had officially surpassed the total recurring tax revenue of these municipalities. Inside the walls of the Federal Reserve Bank of New York, this event was logged as the Inversion Point. To the average citizen, it was just another Tuesday. But inside the systems that govern the flow of global capital, something happened that alters the math for every dollar in existence. The safe bet, the $4 trillion municipal bond market, had just entered a terminal feedback loop. We are no longer discussing a hypothetical risk. We are observing the physical decay of the American experiment meeting the cold, unyielding reality of compound interest, when a city can no longer afford to fix the pipe that brings water to its residents because it must first pay the coupon on a 20-year-old bond held by a sovereign wealth fund in Singapore. The social contract is not just broken, it is liquidated. The $284 billion deficit looming over 2026 is not a temporary shortfall. It is the first crack in a $4 trillion foundation. As of this moment, the clock is no longer ticking. It is counting down to zero. The official narrative is one of renewal. If you turn on the television or scroll through the investor relations pages of major metropolitan areas, the message is consistent. America is rebuilding. The mainstream media points to the Infrastructure Investment and Jobs Act as a $1.2 trillion panacea that will fix our crumbling bridges, replace lead pipes, and usher in a high-tech, smart city future. In the sanitized version of reality, municipal bonds are presented as the gold standard of conservative investing. Financial advisors at firms like Vanguard and BlackRock continue to funnel billions of dollars from retirees and middle-class 401ks into tax-exempt muni funds. They tell you these are safe havens, investments backed by the full faith and credit of local governments with the power to tax. The narrative suggests that while the stock market might be volatile and Bitcoin might be a gamble, the road beneath your feet and the school in your neighborhood are solid collateral. Official statements from city mayors and state governors reinforce this illusion. They speak of temporary fiscal headwinds caused by the post-pandemic transition. They announce modernization levies and sustainability bonds with a tone of quiet confidence. They promise that the recent 15% to 30% increases in local property taxes are merely investments in our shared future. The public is led to believe that the money is going toward progress. You are told your higher taxes are paying for the new electric bus fleet, the upgraded water treatment plant, or the fiber optic expansion. The masses believe that if they just pay a little more this year, the infrastructure decay will be arrested, and the cities will return to their former glory. However, this visible story is a psychological operation designed to maintain the bid in the municipal bond market. If the public realized that not a single cent of their increased property tax was actually going toward asphalt or steel, the market would freeze instantly. The mainstream media acts as the PR department for an insolvent system, using words like resilience and reimagining to mask a reality of systemic bankruptcy. They show you the ribbon cutting for a new green space that cost $400 million, while ignoring the 10,000 miles of Victorian-era sewage pipes beneath the same city that are currently operating 40% beyond their engineering lifespan. They tell you the smart grid is coming, while the actual power lines are being held together by emergency maintenance crews working on 1960s budgets. This is the lullaby of the visible story. It is designed to keep you invested while the exit doors are quietly locked from the outside. To understand why the foundation is cracking, we must look at the hidden physics of municipal finance. This is not about bad management or political corruption, though both exist in abundance, and this is about the debt service spiral, a mathematical trap from which there is no escape within the current monetary framework. The mechanism is built on three pillars of systemic fragility: the cost-push infrastructure gap, the demographic flight inversion, and the weaponization of the special purpose vehicle, SPV. Pillar 1, the cost-push infrastructure gap. Since 2021, the cost of raw materials for infrastructure, bitumen, reinforced steel, copper, and industrial-grade concrete, has experienced a nonlinear surge. While the CPI claims inflation is stabilizing, the Municipal Construction Index shows a 42.7% increase in project costs. A bridge repair that was budgeted at $100 million in 2022 now requires $142 million in 2026. Municipalities, however, are locked into fixed revenue cycles. When a city issues a bond for infrastructure improvement, the principal is often spent just covering the inflationary delta of the project's startup phase. The result is what we call ghost infrastructure, a project that is funded on the books but never physically completed because the capital was consumed by the rising cost of the inputs. In 2026, we are seeing completed project filings for bridges that haven't had a single bolt tightened. The money is gone, but the risk remains. Pillar 2, the demographic flight inversion. The hidden hand here is the movement of the productive class. The very people who provide the tax base, the engineers, the doctors, the high-level remote workers, are fleeing the insolvent zones. In San Francisco and Chicago, internal IRS migration data suggests a net loss of 4.2% of the top-tier tax bracket annually since 2023. When the tax base shrinks, the city's debt-to-GDP equivalent explodes. To compensate, the city must raise property tax rates on the remaining residents. This creates a positive feedback loop of failure. Higher taxes drive more productive people out, which further shrinks the tax base, which necessitates even higher taxes. By 2026, the property tax in certain zip codes has become a wealth liquidation event, where the annual tax exceeds the potential rental yield of the property. At this point, the property is no longer an asset. It is a liability held hostage by a desperate municipality. Pillar 3, the municipal Ponzi mechanic. This is the most critical technical breakdown. For the last decade, U.S. cities have not been issuing bonds to build things. They have been issuing new debt to pay the interest on old debt. This is the classic definition of a Ponzi scheme, but it is legal because it is wrapped in the safe label of government finance. In 2026, the refinancing wall has been hit. Between January and October of this year, approximately $1.4 trillion in municipal debt is scheduled for rollover. When these bonds were issued in 2016 and 2017, the interest rates were near zero. Now they must be refinanced at 5.5% or 6%. This 500 basis point jump is the death coupon. To pay this new higher interest rate, cities are utilizing special purpose vehicles, SPVs, and off-balance sheet accounting. They create infrastructure authorities that exist outside the city's primary budget. These authorities issue revenue bonds backed by future utility fees or tolls. But because the revenue from those tolls is already declining due to the demographic flight mentioned earlier, the SPVs are effectively hollow. They are shells designed to hide the fact that the city is insolvent. The collateral for all of this? Your home? In the fine print of these municipal bond covenants, the ultimate recourse is the city's power to levy an unlimited ad valorem tax. This means that legally, the city can seize the equity in your home to pay a bondholder in London who bought a sustainability bond in 2022. You are not the customer of your city, you are the collateral for its creditors. Finally, we must mention the shadow creditors, the pension funds. U.S. municipalities currently face an estimated $1.4 trillion in unfunded pension liabilities. These are not just numbers on a spreadsheet, they are legal mandates. In states like Illinois and California, pension payments are constitutionally protected. This means when a city has $100 left, it must pay the retired police officer's pension before it fixes the road or pays the teacher's salary. The pension infrastructure inversion is the silent killer of the American city. By 2026, the pension drain has reached a point where maintenance has been removed as a budget line item in 12 major U.S. cities. They have simply stopped fixing things. The system is not blind to these cracks. On the contrary, the central planners are working frantically to patch the system. However, in the world of macroeconomic risk, a patch is often just a way of transferring local failure into systemic collapse. We are seeing a three-stage response from the hidden hand: the Federal Reserve, the Treasury, and the mega banks like JP Morgan and BlackRock. Stage 1, the Emergency Financial Manager, EFM, protocol. In early 2026, we began to see the quiet rollout of the Municipal Stabilization Framework. This is a mechanism where the state or federal government effectively declares the city financially incapacitated. An unelected board of emergency managers, usually former executives from major investment banks, is installed. These EFMs have one goal: to protect the bondholders. Their first act is always fiscal consolidation. This is a technocratic euphemism for liquidating public assets. We are seeing the sale of municipal water systems, parking meters, and even public parks to private equity firms. In 2025, a major Midwestern city secretly entered negotiations to lease its entire sewage system to a foreign sovereign wealth fund for 99 years in exchange for a one-time liquidity injection to cover its pension gap. This is the privatization of the commons as a survival tactic. The system fights back by selling your infrastructure to the highest bidder, who then charges you 400% more in user fees to recoup their investment. Stage 2, the CBD-C-Muni linkage. The most ominous development is the proposed digital infrastructure credit. Under this secret plan, the Federal Reserve would provide direct liquidity to struggling cities, but only through a central bank digital currency, CBDC framework. This would allow the Fed to program how a city spends its money. For example, a city might receive a $10 billion liquidity grant, but the code in the digital dollars restricts their use to ESG-compliant projects. This is how the system uses a crisis to bypass local democracy. The solution to insolvency is the total surrender of local sovereignty to the central bank. Stage 3, the historical anchor and the New Deal. To understand why this is different, we must look at the 1975 New York City fiscal crisis. Back then, the city was saved by a combination of union pension bailouts and federal loans, but in 1975, the U.S. debt to GDP was 35%. Today, it is over 120%. The historical anchor is broken, and in 1975, the federal government could afford to bail out a city. In 2026, the federal government is itself running a $2 trillion annual deficit. The system is fighting back by attempting to inflate the problem away. This is the hidden tax. If the Treasury prints another $2 trillion to bail out the municipal bond market, the value of your savings drops. You aren't paying for the city's failure through a direct tax, you are paying for it through the loss of your purchasing power. The mega institutions are also positioning themselves as lenders of last resort. BlackRock's infrastructure fund is currently sitting on $100 billion in dry powder. They are waiting for the breaking point, the moment when cities are so desperate they will sign yield guarantee contracts. In these contracts, the city guarantees a 10% return to the private investor, backed by a first lien claim on all future property tax revenue. This effectively turns the city into a feudal estate, where the residents are tax serfs working to pay off the private equity overlords. The system is not trying to fix the infrastructure. It is trying to convert the infrastructure into a yield-generating asset class for the 0.1%. The cracks in the foundation are not a problem to be solved. They are an opportunity for the ultimate great reset of local governance. The breaking point is not a single day, but a phase shift. Our models indicate this shift will accelerate in the fourth quarter of 2026. The trigger will be a rating agency cascading default. Currently, firms like Moody's and S&P are maintaining investment-grade ratings on many cities through a mixture of political pressure and flawed probability of default models. But once the first Tier 1 city, likely one with a high pension-to-revenue ratio, is forced into a technical default, missing a single interest payment, the dominoes will fall. When a city's credit is downgraded to junk, its cost of borrowing doubles overnight. At that point, the refinancing wall becomes a refinancing grave. Institutional investors who are legally required to hold only investment-grade bonds will be forced to dump hundreds of billions of dollars in muni debt simultaneously. This is the liquidity blackout. No one will be buying, everyone will be selling, and the $4 trillion market will evaporate. How is smart money positioning itself for the 2026 municipal melt? The strategy is not about avoiding the crash. It is about inverse correlation and asset mobility. Position 1, the zip code arbitrage. Sophisticated investors are liquidating residential and commercial real estate in insolvent jurisdictions and moving capital into hard asset autonomous zones. These are regions with low debt-to-revenue ratios, no unfunded pension liabilities, and most importantly, privatized or highly efficient local infrastructure. They are betting on a bifurcation of America, where certain zip codes become third-world enclaves of decay, while others become gated economic citadels. The logic is simple. You cannot own property in a city that views your equity as its emergency fund. Position 2, shorting the intermediaries. Smart money is moving away from broad muni bond ETFs and instead taking short positions or using credit default swaps on the insurers of municipal debt. There are specialized firms that provide bond insurance to cities. When the defaults start, these insurers will be the first to be incinerated. Positioning here requires high-level access to derivatives markets, but the principle is clear. Bet against the people who promised that the safe bet was safe. Position 3, physical and digital sovereignty. The ultimate position is the move into non-state collateral. As cities weaponize property taxes and the Fed weaponizes the CBDC to save them, the only safe assets are those that cannot be easily seized or diluted. This includes physical gold stored outside the U.S. jurisdiction, land rights in unincorporated territories, and decentralized non-custodial digital assets. The logic: if the full faith and credit of the municipality is revealed to be a lie, the only thing that will hold value is that which requires no faith and provides no credit. The timeline for this transition is narrow. Once the rating cascade begins in late 2026, the exit doors will close. You cannot sell a house in a city that has just declared a tax emergency. You cannot exit a bond fund that has suspended redemptions. The positioning must happen while the visible story is still being told. The reality of the 2026 municipal melt can be distilled into 4 structural truths. Truth 1, the $4 trillion municipal bond market is a functional Ponzi scheme, where new debt is the only thing paying for the interest on old failures. Truth 2, your property is not an asset. It is the ultimate collateral for an insolvent system that has already spent your equity. Truth 3, infrastructure decay is irreversible under the current monetary system because the cost of repair is rising faster than the ability to tax. Truth 4, the bailout will not save you. It will only transform your local city into a technocratic debt colony managed by central banks and private equity. We are moving from an era of civic progress to an era of municipal liquidation. The geography of where you live and where you hold your wealth will soon be the only factor that determines your survival in the Great Reset. When the foundation cracks, the house does not fall immediately. It tilts. We are currently in the tilt. The math does not care about your full faith. The math only cares about the inversion. Prepare accordingly.